Continuing our series of lectures through LVC live virtual classes, ICAI Ashish Gupta, Joint Director Board of Studies, welcomes you all. Now, student, in our last class, that is our first class of this paper, Advanced Financial Management, we have started with the basics of what is a corporate strategy and financial policy all about. Okay, now in today's session, we shall continue our discussion because in the last class I have left you while we were discussing question number 2, okay, of our assignment, and where we have, I think, I hope we have discussed case scenario 1. I remember that. So where the now in today's session we shall discuss how about the case scenario number 2. Okay, so let us see how we draw. One second. Today we shall discuss, we have covered this. So today we shall take up this scenario 2. Now when we talk about the scenario 2, it basically says the change in the total assets in proportion of sales and no dividend is declared. Okay, so here slight different from the top from the first scenario is that in this case there will be a change in the fixed assets as well. Okay, accordingly we have to modify our own calculation according to the same quickly. So student, let us solve quickly this portion so that we can come to the next portion. Okay, so I am just again preparing the modified income statement because that is no more available with us anyhow, no problem. Quickly, I am preparing the modified income statement. One second. One second, I take this another pen. Quickly, I am preparing. I hope this modified income statement you know to prepare again and again because it will be common for this 3 scenarios. Since it has no more available with me on the screen, so I am just preparing it again. So as we have discussed, this amount is sales. Revised sales was 135,80,000 plus 15%. Okay, this was amount was 156 this much. Okay, similarly less cost of goods sold. Okay, it was 70,000 plus 15%. So it was 90,500. Okay, this is gross profit. Okay, now next is less indirect expenses. So again, it is 3395 plus 15%. Okay, the figure comes 39,404,250. Okay, now this figure comes EBIT, that is earning before interest and tax. Okay, so less here interest 1,50,000. Okay, 2972 250. So this is income is earning before tax. Now I deduct the tax from the same at the rate of 42%. So the figure, this here tax figure is 12,48,345. Okay, the net resultant figure earning after tax is this 905. Okay, now here it says it is paying no dividend. Okay, so whatever be the left, okay, whatever be the left, it will be our income. Okay, on the next page I am coming because see, I will take this scenario separately. I'm just adding one more page. Okay, now I am preparing the scenario 2 balance sheet. In a scenario 1, there was no change in the one second. I use another pen. Okay, now I start writing the figure. Here, student, note that since there is increase in the fixed asset, okay, so let us see what will be the amount here. Next fixed assets. Okay, earlier figure was 24 lakh 60,000, but here in the scenario 1, scenario 2, it is says 15% change will be total asset will be changed. Okay, now when we say 15% total asset will be changed, as we know that 50, total assets means current assets plus fixed assets. But since current assets normally always change with the in the proportion of the sales change, so we shall consider the another change of the 15% in the fixed assets. So let us add up this value of the 15%. So the resultant figure will be 28 lakh 29,000. Okay, let me also verify the same so that again it is verified double time. Okay, now next figure is change in the current assets. Of course, all the value will be increased by 15%. So none our figures are cash, bills receivable, okay, and this is our closing stock. So my total figure comes here 17 lakh 18,100. Now I move to the my liability side, and in this liability side, the first item I write is equity. Okay, there is no change in the equity, so it will remain status quo, that is at the 45 lakh. Retained earning. Okay, student, now figure is here. My whatever be the earning that is my left, that is I am reinvesting in the business. So it will reinvested and it will come in the form of retained earning. Okay, right now whatever be the figure of long-term debt, it will be a balancing figure. So I am leaving it here. Okay, now as current liabilities, there will be an upward revision or by 15%. Okay, so my accounts payable, outstanding expenses. So overall, if I tell you this balance sheet, student, my mistake, I'm just writing here. What I did, I mistakenly written the total of, here the total is 69 lakh. Okay, I mistakenly I have written this figure here. Okay, so the total was is 69 lakh. Now what I do, I here write the 69 lakh here. Okay, so just I'm again adding the same so that there is no chances of the mistake. Okay, now I deduct this item, this item. Okay, so when I deduct this all these item from this, you can start with doing with your own calculator. Now student, please remember, whenever we are in the class, it is always better you try at your own also, because if any mistake is there, or it gives you a more clarity. Okay, so the figure, balancing figure comes 4,80,595. Okay, in this case, if we go by what is our external funding requirement, okay, so our earlier debt figure was, in the question, if we see, our earlier debt was for 13 lakh 30,000. Okay, so our new figure is 480,595 minus 13 lakh 30,000. Okay, so external funding requirement will be 8 minus 849,405. It means we have refunded a portion of long-term debt. Please always remember that whenever EFR is in negative, so it means we are refunding some money. Okay, students. So this was our part of, this was a part of our second scenario case. Okay, now I am also solving it by using the formula based approach. So now here in the formula, if I write by the use the formula, so EFR is equal to, that is change in the asset minus change in the liabilities, that is in proportion of current liabilities, basically it is, and this is our new sales margin, that is, or we can say it is a profit margin that we have retained. Okay, now since here we see that there is a change of 15%. Okay, so we, whatever is the value of 15% of 24,60,000 here, this value will come here. Okay, so this we can say this value plus this value. Okay, overall change in the current assets, overall current assets as well as fixed asset, both. Okay, please always remember, here the asset is basically the both fixed assets as well as current assets, and here it is the current liabilities. Okay, then we can compute the overall increase. So here we can see that earlier this figure was 60 lakh, now this figure is 69 lakh. So accordingly, the change in the overall asset portion is 9 lakh. Okay, now when we change here, see here the change of the current liabilities. Here the change of the current liabilities is 25,500. Okay, now whatever is the profit margin we have retained, we have retained the profit margin this much. That is 17 lakh 23,905. Okay, so the figure comes here minus 849,405. So the figure is the same as it is for the same. Okay, student. So I hope this scenario 2 must be clear to you. Now I am moving to scenario 3. So first of all, I will prepare the scenario 3 balance sheet. This is the liabilities. So if we see all the items will be the same. Okay, so quickly I am writing these items. Now here in the scenario 3, if I go by the scenario 3 balance sheet, what they require additional things, let us see what they additionally require. Here this condition is same of the second, that is change in the total set is in the proportion of sales, that is 15% will be changed there. But here one additional point, this is 50%. Okay, this is 50% of the profit is declared as a dividend. Okay, so accordingly I have to slightly modify my income statement. You see how I will modify my income statement. So here the income statement will be modified. Less dividend declared. So student, when you in the exam is this type of a question comes, you prepare only one income statement first, and you declare also include there the declaration of dividend. Of course, you will use only two in the first two scenario, this part only up till this part only. But in the case scenario in the scenario 3, you will use the third next part, that is post dividend earning. Okay, so dividend declared is here is 1723,905 divided by 2. So some figure it comes 861,952. You can take 3 as well, no problem here. Okay, so the retained earning now figure will be okay. So now I will take this figure here. Okay, first part is my fixed assets. Again 15% increase. Bills receivable. Closing stock. क्या की जरूरत है फ्रैंक, इसमें मेरा वो नहीं आ रहा, स्क्रीन नहीं आ रही है, स्क्रीन से गया. Okay, student. So here we have written these figures. Okay, that now here the total will come 69 lakh. Okay, now I move to the liability side, and first item is equity. Okay, then it comes the retained earning. Now here the retained earning figure will be half of it that we have calculated. Okay, now again as I am doing the long term debt, I am showing as a balancing figure. Okay, now I am moving to current liabilities. Which is increased by 15%. Okay, so this becomes accounts payable. So if I write here 69 line again, so my balancing figure will be now I can see here that my earlier figure was 13 lakh 30,000. Okay, so here this now here some slightly increase is there. So now I compute external funding. Okay, external funding requirement. Okay, my new figure is sorry 13 lakh 30,000. Okay, so 12 lakh for it is a positive value here means they have to raise some additional debt. Okay, students. So with this, we have come to the end of this question number 2. Now, quickly, I am taking to you to the question number 3 of our assignment, and this question has been adopted from our earlier examination. Okay, this was somewhere around in 2021 in the old scheme. So I'm just taking you there and we will discuss this question. Just read the question carefully so that I will start solving the same. The question says like this. The balance sheet of MS Sundry Limited as on 31st March 2020 is as follows. The liability side has been given to you, asset side has been given you, all the figures are in rupees lakh. So the items are like this: share capital, reserves, long-term loans, short-term loans and provision, payable and provision. Fixed assets figure has been given here, assets on asset side, inventory, receivable and cash. So the total comes 14 lakh here. Now further it says in additional information, sales for the year was rupees 600 lakh, 6,000 lakh. So this figure is basically relating to the year pertaining to 31st March 2020. Okay, the sales are expected to grow during the year. Now it is saying about the forthcoming year. Okay, the profit margin and the dividend payout ratio are expected to be 4% and 50% respectively. Here the companies have some more conditions. Okay, the company further desires that during the current year, sales to short-term loans, okay, sales, these are very important points. Sales to short-term loans and payable and provision should be in the ratio of 4:3. Okay, ratio of fixed assets to long-term loan is 1.5 and debt equity ratio should not exceed 1.5. You are required to determine the amount of external funding requirement and the amount to be raised from short-term, long-term and loans and equity. Now, student, please note that in earlier questions, in these questions, basically we were determining the external funding requirement, keeping in view that we can say that there are no such conditions were attached that we have to maintain this ratio. They were all are spontaneous. Okay, so whatever the source of funding are there, it can be either in the form of, mostly it was in the form of debt ratio. We are using the debt. We are using the debt in earlier scenario, and it is always presumed that generally we use the debt. But here it has given the conditions. Now, when it has given the condition, then we have to analyze from this point of view that our external funding requirement should meet all these three criteria. Okay, it should meet three criteria. So it has set up a boundary for that we should follow within this boundary. We have to do the make the arrangement for the external funding. So let us start solving the question quickly. So and it is one of the very simple question. Okay, but only the condition is that I can present you in a two manner. One is another. We have taken the main solution and alternative as well. So you can solve both ways. And a very important point here, whenever we solve the question, so we have to remember one thing that either we can use a sales based approach or the formula based approach. Both approaches we can be used. And when we will solving the question, we have to very careful about our presentation, because here the presentation will matter a lot, because we have to meet these criteria. Okay, so let us start solving the question. So first of all, whenever external funding requirement, in a very important point, in question of external funding requirement, the first part is required is basically how much retained earning will be left with us. It is one of the very prerequisite of external funding requirement, because the first step in a growth that is first is met it from your own sources. And generally in our own sources, if if 100% has been declared as a dividend, then nothing will be left for the internal retained earning and nothing will be reinvested. But however, if a part of the earning has been plowed back, so then some part is with us, balance here we have to meet from our other sources. So this is our whatever funds requirement, a part will be financed by our internal funding. So this is question number 3. I think I take some little bit different color. So first part is external funding requirement. Now here, if I move to the question, this is our expected sales. Okay, now here it says sales for the year was 6,000 and it is expected to rise by 20%. Okay, the profit margin is 4% and it is payout ratio is 50. So these are the main constituents of our income statement, or we can say from these figures we can calculate the portion of the retained earning. The first part is expected sales. $6,000. Okay, now profit margin. Now dividend payout. Okay, dividend payout is 144, 50% of the same. So the retained earning okay. Now next part is additional fund required. Now when it says that additional fund required, let us move to the question again. It says our sale is expected to rise by 20%. So when it is rising by the 20%, so of course our all the items, see here is nothing has been mentioned that there will be change in the no change in the fixed asset, no change in the current like nothing condition has been mentioned. So we will presume that in this case it is very important to remember that there is always the assumption that our all the assets inclusive of fixed assets will be increased in the same proportion, that is 20%. Okay, so what we do, how we compute this additional funding requirement, our sorry our it will increase by 20%. However, a part of the same, okay, a part of the same will be met by payables and the provisions. Please remember, although short-term loan is a current liabilities, but it is not considered as a spontaneous source of finance. Please remember, short-term loans are not considered as a short-term finance. So accordingly, what we shall do, we shall here increase a part of it spontaneously financed by our current liabilities. Okay, so we also, it will also increase, or we can say here, okay, so this will be increased to our, this will lead to increase of, okay, so out of this 2400, a portion is met by this 144. So AFR, balance to be met from external sources. That will be B minus A, and that will be 2256. Okay, student, I hope now, till this point of time, you don't have any doubt. Okay, now let us move the next part. Now we have to meet this requirement from the external sources, but side by side, we have to also to meet the conditions as well. Okay. The conditions are like this: sales to short-term loans and payables and provisions should be in the ratio of 4:3. Okay, second condition is ratio of fixed assets to long-term loan should be is the ratio, it should be the 1.5. Okay, and last is debt equity ratio should not exceed 1.5. So now let us start meeting these conditions one by one. Okay, accordingly we shall see. So first condition is relating to short-term loan and provisions. Since we have to meet this condition, so we draw out here amount to be raised short-term loans. See here, student, very important. Since payable and provisions will automatically increase in the proportion of the growth, so whatever the amount we have to decide about this factor, that is short-term loan. It is very important to remember. Okay. Net amount of short-term loans and payable and provisions Okay, since it should be in the ratio of 3:4, means whatever we if our sale is 4, so the short term loans and payable and provision should be 3. So accordingly our new sale is 7,200 lakhs. So our new figure comes, we compute like this. Okay, now we from this we deduct less existing amount of short term loans and payables, provisions and payable. Okay, so here we have to see that, see student, please note that again I am taking you to the question. This will, as I told you, this will amount will increase proportionately with the sale. So first point what we do, we will increase this amount 2000 into 1.2, this is the revised amount, plus the old amount of short term loans, that is 3000. So the figure comes 5400. So accordingly there will be nothing will be required, amount to be raised from short term loan will be nil. Okay, is that clear now? So okay student, now let us move to the next part. Next condition says ratio of fixed assets to long term loan should be 1.5. So now it means if our fixed assets long term loans are 1, okay, so our new fixed assets should be 1.5. Okay, so now we will meet this condition. Net fixed assets, as I told you, here I take up you and take to you the question. Here fixed asset is our 6,000, plus I have told you it will be increased by 20%. Okay, this figure comes okay. New long term loans, but the criteria they should meet, that ratio of 1.5. Or we can say here revised figure of revised long term loans. How much amount it will be there? Oh, sorry, it is already come here. We have come to take it. Here it will be the existing or we can say here that I think it will be the revised, it will be proper. So the existing amount here is 4,000. If we can see here from the question. So the how much amount we shall meet from the long-term loans? Okay, student. So here I think till now you don't have any doubt. We are coming to the third point. Okay, a third condition we have to meet is debt equity ratio should not exceed 1.5. Okay, so last point is now here let us see how much amount we have to raise from the equity. Our EFR requirement is, as we have computed our EFR requirement, it is 22,560. Okay, now less amount to be raised from short-term loans. Here it is nil. Okay, less amount to be raised from long-term loans. It is 800. Okay, so balance to be raised from equity. Okay, student. So this was a basically a simple presentation. We can say from the pro forma statement, we can say, or the sales ratio approach, from where we start with the revised sale and then we move further. And then there is another approach from where we can use the alternative approach, or we can say formula based approach. So quickly I solve it here. Okay, so that we can come to the next question. But here our approach will be slightly different. Here what we shall do, we will meeting the sources from the various, we will meet our requirement from the various sources, and we will see, we will observe whether our conditions are met or not met. There is another version of the formula: total assets divided by sales minus payables and provisions divided by sales. This has been met, and that is the change in the sales figure minus net profit margin into projected sales. Okay, 1 minus D. Okay, same as we have done earlier. So first of all, we compute the external funding requirement. Now here our existing asset, total assets is 1400 lakh. Okay, our sales figure is this much. Okay, now let us see the question. This is 14 lakh, 14,000. Okay, now a part of the payable and provision is 2000. So I am writing it here. Sorry, 14,000. Okay, our change in the sales is 1200 because 6,000 sales, there is an increase of 20%. Okay, so this figure comes 1200 minus our profit margin ratio is 4%. Okay, our revised sale is 7200. Okay, 1 minus 0.5, that is dividend is retained in earning is 0.5. Okay. Now, when we compute this figure comes rupees 200. This much figure we got. Okay, now we start see the various conditions, how we can meet the various conditions. Okay, first part is short-term loans. Okay, now let us see how it will meet. Now it says 4 is to be sales ratio should be is to 4 is to 3. Okay, so right here sales 4, then our short-term loans and provision should be 3. Okay, so our new sales is 6,000 into 1 by 2 divided by our existing provisions will automatically increase plus X, that is the new revise, or we can say it is a kind of a revise revise figure. X here written here. So we solve it, we get the value of X as 3000. When we will solve this equation, we will get the value of X as a 3,000. Okay, so revise amount existing amount of short-term loans so additional amount to be met from short-term loans is nil. Okay, so by this we have met the condition as well, and we have computed that where how much amount we have to. So we can see here that if we see compare with our first solution, it is the same. There is no change, only the manner of presentation is different. Now I'm coming to the next part, that is how much amount is required from the amount to be raised from the long-term loans. Okay, again here we assume that let y be the revised amount of long-term loan meeting the given conditions. Okay, the condition is like that 1.5 should be equal to fixed assets divided by long-term loans. Okay, see 1.5 is given and new, yeah, we can say revise fixed assets. Okay, so now earlier figure our fixed assets were 6,000 into 1.2 because there is a change of 20%. Here this figure is 6,000. Revised amount of loan is y. Okay, accordingly we compute the value of y. The value comes 4,800. Okay, so this is the revised amount of the loan. Revise or new, whatever we can write, no problem. Okay, so existing amount so this amount we have to be raised from the okay. So here if we go our check our alternative previous approach, so the answer is the same. Okay, so there is no difference in answer. Now last point, we are relating to our equity requirement. external funding requirement 2 to short-term loan nil. Okay, less amount to be raised from long-term loans. It is rupees 800 lakh. Okay, so balance amount to be raised from equity is 1456 lakh. Okay, so if we see here our previous presentation, the figure is same. But before concluding our answer, it is very important that whether it meets the criteria or the condition that has been prescribed. So accordingly, we have to see whether the given condition is met or not met. So let us see. We will compute revised debt equity ratio. Okay, so now when we will calculate, this is revised debt, or we can say revise. Here we can also revise the revise. This is also the figure revise. We can write or not write, it hardly matters. But here the revised word is very important. Okay, so now when we calculate the revised debt, please see here, our existing debt is 4,000. Okay, accordingly, I write here 4,000. However, I have issued some additional debt of 800 lakhs. Okay, so that will be written here. Divide by, now here I need your attention. When we will calculate the basic our requirement, that is what is our shareholders fund. So here we will need to take care, we have to take a care. Okay, so shareholders fund is equity, no problem. See, equity is there, 3,000. Okay, no problem. Then reserve figure is there. Reserve figure is 2,000. Okay, so we will write 2,000, and this two figures we will write 3,000. Okay, 2,000 plus one more thing. Okay, one more thing. What we shall do? Reserve is 2,000. Okay, and how much we have retained the earning? Let me check. How much we have plowback? 144. Okay, so we will write here 2,000 plus 144 plus, there is one more important point here. Okay, shareholders fund. Okay, how much equity we have issued? New 1450. So this will also come the revised equity figure. Okay, so this is the revised reserve figure. This is the new equity, and this is the existing equity. So all part we have covered. Okay, now when we will compute this ratio, it will become approximate 0.73. So it is not exceeding. Okay, it is not exceeding 1.50, that is given the conditions. So hence the condition is met. Please remember, only one presentation you have to give in the exam. You have to write both presentation, alternative presentation in the examination. Okay, student. So with this, we have come to the end to our question number 3. Okay, we are moving to the question number 4. Okay, that has been recently come into the our recent examination of January 2026. So I am taking you to the question. This is a question number 4. It is little bit long question, so I am just start give a reading, then I discuss with you. So it says that like this: MNC Limited company's financial statement for the year 2024-5 is provided as. So this is the income statement. Okay, so we can see that here sales revenue is 7,500, 7,300 is cost and expenses. Then our income before taxes is this, and the taxes is 60, that is we get 30%. So net income is available with us is 140. Okay, now it says MNC's balance sheet as on. Okay, 31st March 2025, the equity is there, long-term debt and the current liabilities, net fixed assets and current. The two items are there. This is a total is 6,000. It says the company expects a 40% sales growth next year. Okay, how much it is expecting? 40%. Now the company will have 25% dividend payout next year. So they are expecting that they will pay around 25% next year, whatever be the earning. All cost and current assets and current liabilities are expected to increase with the sales. So it is expected that the sales, current assets and current liabilities will increase with the sales. So here, although it is understood, but here they have also given it with the clarity. This is a implied assumption, but they have explicitly covered it. Now, except retained earning, no equity to be raised. Now, this is a condition. No equity we have to raise. Okay. So now in that case, it says compute the external funding requirement, raising the long-term debts. Okay, raising the long-term debt. So they say you have to only use long-term debts to meet the requirement. Now, they have given two conditions. If the company is operating at 65% of capacity usage of fixed assets, and if they are operating at a 95% usage of fixed asset capacity here. So these two are criteria where we have to compute external funding requirement, assuming that there will be no additional equity will be issued, only whatever is the portion with the retained earning, except that no additional equity will be issued, only the retained earning will be utilized and balance will be met out from the long-term loans. So let us start solving the question. I hope the question is giving clear to you. So let us start solving the question. Again, student, here there are two type of presentations we have considered in our model solutions. So I am starting with the first presentation. Okay. First part is external funding requirement. Okay, so we write it here like that with only 65% utilization. Growth of 40% can be achieved in the fixed asset level of. Now here, see, our basically we are operating at a 65%. Earlier, our asset requirement was 1. Now it will increase to 1.40 because there is a sales growth. So what we require? We require the utilization of asset 1.4 time of existing assets. So, but we are using only the 65% of the existing assets. Okay, so please remember, it is very important. Now we require the 1.4 time of the assets utilization, and but since we are using only 65%, 1.4 time of assets level is required, and since we are using only 65%, so the level of asset is required is 95%. Okay, which is less than 100%. So or we can say that 0.91 less than 1. So ultimately, thus no addition is required in fixed assets. Okay. Now let us compute external funding requirement through long-term debts or loan or debts. So let us start what we shall do. First of all, we shall compute the net income. Okay, and then we will see how we will meet this requirement. So let us start writing rupees crore. Expected sales revenue. Rest cost and expenses. Okay, income before tax. So this is our next net income. Okay, now it says, now let us move to the question. The company will pay out 25% of the next year. Sorry. So our dividend payout ratio will be the 25%. Sorry. Okay. So the retained earning, or we can say that it is the internal source of fund. Now, next it says how much we have to meet additionally. Okay, so since it will increase all the proportion, like here current assets is this much and current liability is this much. So we have to meet some our short-term requirement. Okay, additional funds required means this minus this. Okay, into 40%, and because in the question it has said like that, all cost, current assets, and the current liabilities are expected to increase with the sales. So we are assuming there will be no change in the fixed assets. Why? Because fixed assets, there will be no change because it is ultimately using the 91% of the same. So fixed assets will be the status quo. Only the change will take place in the this portion, our current assets portion, current assets and current liabilities. Okay, current assets minus current liabilities. Now this will be 2000 minus 1500 existing position into 40% increase. Okay, so balance we shall meet. A part is met by the retained earnings. This is the requirement. So balance shall be to be met from long-term debt. Okay, now next case we consider external funding at 95% utilization of fixed assets. Okay, now I repeat the line this here with only 60. Now here I will write with only fixed asset sales growth of 40% can be achieved by revised level of fixed asset at. Now here let us see our sales is fixed asset is our 1200. Okay, now required level is 1.4. Okay, so it becomes figure 1.1320. Okay, however our utilization is 95%. Okay, so sorry, our fixed asset is, let me check, our fixed asset is, sorry student, now sorry, our fixed asset is 4000, my mistake. One second, our existing fixed asset is 4000. Okay, our revised will be 1.4 since it is using at 95% utilization. Okay, so the revised level comes 4000 into 1.4 into 0.95. Okay, the figure comes revised 5.320. Okay, now with this figure 5.320, the existing amount of fixed asset is rupees 4,000. Hence, additional amount of fixed asset shall be required 5,200 minus 4,000 crore, that is 1,320. So this will be the additional amount will be required on account of a fixed cost. Sorry, student, I think fund 5. Yes. Okay. Or we can say the projected fixed cost, fixed assets will be rupees 5,320 crore. So now let us see the final part. So our again expected sales, income before tax, okay, net income is 196. Okay, dividend payout, at the rate of 25%. 49, no, same here till now, there is no change. So this will be the retained earning. Okay, that is source of internal funds. Internal source of funds. Now additional fund required. Here I need your attention. Well, rather I will say I will write it here with the different kind of a pen because I need your attention here. Additional fund required. So here please see, we shall go first consider the revised figure of our fixed assets, okay, plus our current liabilities, okay. So current assets. Here this figure has become 5,320. Okay, this figure has become 2,800. So the total figure becomes 8,120. So this will be the revised assets figure. Okay, one part is met from the current liabilities, as we have considered here, this part. Okay, when we revise figure is here, minus okay, equity, existing equity is there. Okay, so these are all revised figure. Okay, existing equity minus debt. Okay, these two figures are we have taken from there. This is debt. Okay, so when we compute this figure, it becomes 1250. Okay, thus the balance to be met from long-term debt. The resultant figure is 13,000. Okay, student. So with this, we have completed the one presentation part of our question number 4 of the assignment. Now, students, so far as the alternative presentation of this question is concerned, I will request you to please refer the suggested answer, okay, at your own. In case you have any query, you can discuss with me, because this is one of the very good part. We can say, I think it is the most proper appropriate presentation for this question. So student, here we are taking a small break. Okay, it is right now 8:30. So we will reassemble at 8:40. So thank you for a break. Thank you for your patient listening. So we are having a small break, and please stay connected with us. Thank you. Started. Okay. Now, before going on a break, we have covered our questions relating to external funding requirement. Now, there is another aspect of our strategic decision making, although this topic is covered in the security valuation, or that is bond valuation, where there is a bond valuation. But here we are taking this up topic, the refunding of bond, because it is a kind of a strategic decision. Now, students, see, sometime what happen, I tell you generally what happen, just please remember one thing. There are two type of interest rate. One is fixed, another is floating. So fixed interest rate remains the same and floating keeps on changing. Now, generally what happens whenever any company issues the bonds or debentures, they are generally at a fixed rate. Okay, if you have noticed that, like especially when we start, I remember that when we were start doing the company accounts in class 12th. So in every debenture or preference share, there used to be prefix like 8%, okay, 7%. So these were used to be prefix. Okay, so before equity, there is no prefix because the dividend is not fixed. So ultimately, it indicates rate at which the bonds or debenture have been issued. Now, see what happened. Generally, it depends. Whenever any debenture or bonds are issued, it is related to the, or we can say it depends on the prevailing interest rate prevailing at that time, at that point of time in the market. But later on, there may be some change. Okay, this change can be both way, upward or downward. Problem is that if there is an increase in the rate, okay, then there is not a problem to the company. Say at say year one, company has issued a debenture at the rate of or bonds at the 8%. After 1 year, the rate of interest becomes 8.5%. Then the company will be at a privilege because they are paying only on the same bond at a rate of rupee at a 8.8%. Whereas if they freshly issue the new bonds, they will be issued at a 8.5%. So ultimately, they are at a benefit. The problem start when this interest rate start reducing. So now, like here in this example, in the diagram I have shown, where the company is showing that they have issued at a 10%. Okay. Now, with the after 1 year, 2 years, say 1 year, the rate of interest start declining. Okay. So we can see that in the within a span of 5 years, the rate of interest has reduced to 6%. So in that case, what happens? Company will start exploring the possibility of refunding the money. Okay, they will say that why not we issue? This is called refunding or refinancing. It is also called refinancing of the bonds. They will say, why should not we issue the new bonds, okay, at a lesser rate of interest and refund the old bonds at a higher rate so that we can uh, save our money. But please always remember, so how do we escape the premium and refinance at a discount? This is a criteria. But because premium they are paying here, they say if 8% rate of say 8%, at 8% they are paying a premium of 2%. Here, okay, at 6% they are paying a premium of 6%. So ultimately they are paying a huge amount. Okay, so what they do, they have to take a decision. Like in the study material, we have seen that a company issued a debenture or a bond at 8%, historically likely to replace this at a 6%. But only the catch is there is that there should be a call provision in the debentures or the bonds. I remember that it is in maximum lecture I refer the same. Somewhere around 2000 IDBI, I remember 2002 or somewhere, yeah, it was somewhere around in 2002. Why, when the prevailing rate of interest was somewhere around 9%, 8%. So they have come out with the infrastructure bond. Okay, I have purchased the infrastructure bond at that time, and I think rate of interest was somewhere around 8 to 9%. But later on, around say 2008 or 9, the rate of interest has come down to 6 to 7%. So they were having a call provision. As per this call provision, the company can call this debenture anytime, bond. Okay, this is a give them a option or a right or a choice, not an obligation. Of course, it is not an obligation to call the previous time. So they generally they call the call back, or they say premature this bond before the maturity period. Okay, say a bond is having a life of 10 years. So here they can, if the call provision is there, they can they can redeem the debenture before the maturity period. So this uh, very important that call provision there should be there. But very important, a catch is there. This generally call provision is not free of cost. Okay, generally what happens, whenever company call the bonds earlier before their maturity, they have to pay some premium. This is called call premium. Okay, this is called call premium. So they have to pay some more amount than the face value. This is called call premium. Okay, now similar to, it is just only from the your understanding point. Similar to call provision, put provision is also provided to the investor. Okay, sometime this choice is given to the investor. They can they can surrender their debenture or the bonds to the company before the maturity, and this provision generally they will exercise the provision in case when the rate of interest is going on a higher side. So we can say that the call provision company exercise by the issuing company, and this is exercised by the investor. Core action, redeem before maturity. Okay, demand early redemption. So this is by the company and this is by the investor. Now what are the trigger point here? When the interest rate are falling, the company can call for redemption of the demand. When interest rate are rising or a credit downgrade, it may be possible that company's credit rating may be downgrading. So in that case, they want to be on a safer side. They will like to withdraw their money before the maturity period. They will want wait till the maturity. Risk bearer. Here it poses a reinvestment risk to the investor. Okay, because now the company can call the bonds before their maturity period. So of course, the new bond, if they will get back the money and they will invest the money in the same category of bond, it will be reinvested at a lower rate of interest. So this is called reinvestment risk. Okay, poses liquidity risk to the company. Okay, if debenture have been investor has demanded their money with prior to its maturity, and the company is not prepared at all, so ultimately it will pose a liquidity risk for them. So we can say that call provision protect the issuer's ability to refinance, while the put provisions protect the investor's capital. So this is generally a summary kind of a thing. Okay, student. So now when we have to call up the bonds refunding, so we have to view it from the strategic lens. Okay, and what is the strategic lens? Basically, what we do, we carry out the fundamental, and we can say fundamentally capital budgeting analysis. Okay, we have to say, like I need to explain you the NPV. NPV you have done at your intermediate level. So we must weight the immediate friction cost against the long-term debt flows. Interest friction means initial outlay in the cost. So this can be in the form of call provisions, premium. Okay, what are initial outlay? Flotation cost of new issue, because they are refinancing this. Okay, and then percent, what is our saving? Percent value of an interest saving over the remaining bond of life, remaining bond life. Okay, so this is a rule. Present value of saving as NPV is greater than the initial outlay, then we should give a positive NPV and then company should refund the bond. Okay, student. So this is like the initial NPV analysis that we have done at our intermediate level. Now, student, uh, let us solve the question number 5 of our assignment. Okay, of course, some students are saying that sir, assignment is not available. As I told you, I will share my email ID with you. You please send me the request. I will share the assignment immediately. Okay, so please note that so that you can, otherwise these questions are from our study material, most of the questions, so you can refer from there as well. So please read the question number 5. The question says like that: DEF Limited has a outstanding 10% callable bonds. So this is a prior condition, okay, of rupees 20 crore that has 10 years to maturity. The call premium is 7% of par value of bond. So it is a call premium. Since the last year, the some due to falling interest rate, the company in the market, the company can issue 10-year bond with the same feature. So see here, 10 years have been left, or similar 10-year bond can be issued with the same features at the rate of interest of 8%. So it means there is a benefit of 2%. Okay, the flotation cost of the new issue is expected to be 60 lakh. So it is a part of initial outlay. Similarly, this call premium is a part of initial outlay. And what will be our saving? Our saving will be 2% of interest per annum on the bonds for the 10 years. Okay. You are required to advise whether the company should refund the old bonds and issue fresh bonds or at a lower rate or not. So now we have to compute the NPV. For NPV, we use the present value factor. It has been given in the question. However, please note that even if this table or this value has not been given to you, sometimes they may give you the hint of that the company's cost of debt. Please note that you have to assume the company's cost of debt. If even it has not been mentioned, so it is always we shall discount it at a 8%. That is post-tax cost of debt. Okay, so now let us start solving the question. Okay, and see how we can compute take the NPV decision. First of all, as our first requirement is initial outlay, the 20 crore is there. We have to pay call premium. Okay, flotation cost. So overall, this initial outlay will be rupees 2 crore. One second, I think all premium. Okay, so total is 200. Now we will compute the annual saving. So this will be 2 crore. Okay. Okay. So here it is new interest rate at the rate of 6%. It is 20. Sorry, 20 into 100 into. Okay, the saving will be of 4 crore. One second. One second, student. I think there is some mistake of 0. Okay, so there will be a saving of one second. 1 crore 60 lakh. So saving will be 40 lakh. Okay, so present value. Now we shall compute NPV of bond refunding. Interest amount. So see, student, what we do, we carry out the total of this factor. Okay, the factor total is 6.709. Okay, student, please note that if in the question, in the examination, some table has been given to you, So you have to consider the decimal point up to 3 decimal point, whatever have been given to you. If they have been given up to 2 decimal points, so consider the same. Otherwise, if nothing has been mentioned, then 3 up to 3 decimal point are considered to be a good practice. Okay, up to 2 decimal point give a quite some can give a some vague results. Okay, so the total comes is we multiply this present value of saving this 40 lakh into 6.709. Okay, the figure comes 2 crore 68 lakh 36,000. So this will be the present value of saving less initial outlay. So our NPV is positive. Okay, this conclusion is very important. Okay, without this, generally, when we have observed from the past performance of the candidates, where the examiners have given their views. So generally, they have said their comment is that generally students forget to give a comment, although they may give the answer up to this point, but they give a final conclusion. So conclusion is very important. Okay, student. So now let us move further. Okay, student. Now see, there is another issue in this area is that sometime what happens, uh, there is a catch. There is another, we can say there is a problem is that I just give you a very small example. Now, say in a 5 to 6 year, the company decide, yeah, okay. Now from 6 year, if the say the rate of interest has come down, they want to go for a new issue. Now what happens? Sometime the company may decide here, and refunding of the bond may take a some time. Okay, so what happens whenever 1 second. 1 second. Okay, sometime what happens? Say company at this point, companies at this point, they decide that we will refund the money. Say today is June month. Okay, and they will issue the float. They will come out with a new bond issue. So overall, what happens? This bond period may take some time, and ultimately this bond say are issued in the month of August. Okay, because they have to refund the money. So what happens during this intermediate period? They have to pay interest on both bonds. Say today they issue the bonds. I just tell you, today they issue the bonds, new bonds here. Okay, and they redeem old bonds here. So during this time, when the new bonds have been issued and old bonds have not been redeemed. So this during this time, it may be possible that they may have to incur the payment of period, because generally what happens, if the call provisions they are they have because first of all, for paying the money to the old bonds, first they have to issue the new bonds, because this exercise cannot be like that. I just give you a very small example. Whenever any person is buying a property, okay, so generally what happens, his preference is that first I get the money by selling the property, then I will purchase the property. Because if he will start, he will like to you will say collect the day on a same day property. One day he is selling the property, another day, and the same day he is trying to buy the other property. It is not possible, because there may be some can be cap, etc. So what they do, today they are issuing a bond at a 6 June month, and ultimately they are redeeming the bond in a 8 August month. So during this period, for the 2 months, 6 to 8, generally they pay, this is overlapping period is there. So here they have to pay the interest, and in the NPV analysis, we shall also consider this period as well. So our next question is a very, we can say, good question, because they will also consider some other nitty-gritties also. There is another point in NPV. So first question was very simple question, like in a previous bond, there may be some unamortized amount. यार AC चला देना यार, AC चलाओ, AC चला दे. There may be some unamortized amount. Okay, there may be some unamortized amount to be written off. So that has to be claimed as a, that has to be claimed out as a written off. So once what happens, whenever any new bond is issued, old bond is redeemed, so whatever with the unredeemed unamortized amount is left, that is automatically we can say written off in a one go. So this is a one part, in one part also. So we have to also make a very you can say that we have to do a very minute comparison, or a minute analysis of this kind of a provisions as well. So our next question is we can say that is a more containing the more provisions relating to the same type of practical problems. Okay, this is one of a question from our earlier examination. Please read the question so that we can solve the question. This is the last question of our assignment as well as our this chapter. After this, our this chapter will be finished off. Just read the question. Okay, it says like that MES Trans India Limited is contemplating calling 3 crore 30 years rupees 1,000 rupee on the bond issued 5 years ago, a coupon interest rate of 14%. So it means it is the face value. 5 years ago means 25 years has been left. The bonds have a call price of 140. So it means call premium is 140. Had initially collected a proceeds of 2.91. So it means our discount was 0.09 crore. Okay. Due for to a discount of rupees 30 per bond. Okay. The initial cost, floating cost was 3,60,000. The company intends to sell rupees 300 crore of 12% coupon rate. So it means earlier it was 14%. Now it will be 12%. So there will be a saving of 2% straightforward on this 3 crore bond. 25-year again period is there. Okay. To raise it is proposed to sell the new bonds at the par value of rupees 1,000. The estimated flotation cost is 4 lakh. The company is now paying 40% after tax cost of debt 8%. So it is now this, since it has given to us, so we shall use the NPV basis, discounting rate base, as the new bonds must be first sold and their proceed then used to retire the old bonds. Please note that this is the intervening period. The company expects a period of 2 months. So it expects a 2 month period will be there, where will be the situation is like that. During which the interest must be paid on both the old and new bonds. What is the feasibility of refunding the old bonds? Okay, student. So now let us see the solution. Students, please note that here the working, we will start with the working notes, and working notes are here in this question are very important. So first working note is relating to initial outlay. And very important here, we have to keep in mind that tax applicability is very important factor here in deciding about this, all in computation, all working notes. Before tax call premium. Okay, so here it will be premium will be, this is the number 30,000, this is the number of bonds. Okay, less tax at the rate of 40%. Why? Because we will get the benefit of this call premium. Okay, we will get the benefit of this call premium. So this is our net outflow. Next part is flotation cost for the new bond. Next part is overlapping interest. Interest for the all the overlapping period, we can say. For 2 months. Okay, let's we deduct the tax. We shall take a benefit. Tax is our main. You can see that in a NPV decision always said that tax any charge against the profit that is considered for the tax is considered as a cash inflow. Okay, it is generally considered as a cash inflow. It is always a benefit. No, I am writing with no. These are this. Now I am writing with a different ink. Here, all these are our inflows. Okay, these are our outflows. Now here I am writing another figure is that is giving you inflows. So whatever be the tax benefit on unamortized amount, that will be considered as a inflow. Okay, so see here it is very important to note our bond's life was 30 year, 5 year have been lapsed. Okay, leftover period is 25. Okay, and whatever our discount amount, okay, whatever was our discount amount, that was 9 lakh. Okay, so 9 lakh into 0.40, that is tax provision. Okay, we shall consider as a tax benefit. So accordingly, the proportionate balance amount will be 25 by 30 into 9 lakh. Okay, into tax benefit is 40%. Okay, so ultimately this tax will be a tax saving. So it will be opposite to the same initial outlay. Okay, next another part is tax saving on the flotation cost. Okay, unamortized. Similar to it, 30 minus 5, 25 again. Okay, the and flotation cost is 3,60,000. Okay, so this is our tax benefit. So net amount. Okay, next. Okay, so our initial outlay will be 29 lakh. 29,000. Okay, so next part is our annual cash saving. Annual cash flow saving. It is one of very important point. Since our earlier bond will be at 14%, so we used to pay 42 lakh each year. Now this was net of cost, net of tax cost to us. Okay, now tax saving for this old bonds. Right now I forget here. I am just whatever writing. I am writing with the. This was our outflow. Okay, this was our outflow. Old bonds outflows annually. Okay. Now what about next our outflows was? It was a tax saving. Again, I am writing with a different. So whatever our tax saving on amortization. Okay, of discount. So what our discount was? One divided by 30 into 40%. Okay. Similarly, our tax saving on amortization of flotation cost. Okay, so this comes. So net figure comes. So this was the annual outflow of old bonds. Now we add, we see what is our new bond annual outflows. Interest amount. Less taxes at 14%, 40%. Okay, so this comes 21 lakh 60,000. Okay, here next part is amortization of flotation cost. That is a saving. So it will be negative. Okay, here there is no discount. Please remember that there is no such kind of a discount is there. This in a new bond. Okay, only the one factor we will get the benefit, tax benefit of only one point, that is amortization cost. Okay, so tax benefit of amortization of this. Okay, here it comes. It is 25. Very important. This figure has to be remembered. Generally, students commit mistake here. They say here 30. That is a wrong. 25. That is a crucial point. This is a one of the mistake point where the student commit a mistake into 40%. Okay, student. So net outflow per year will be okay. So we can say that it is a this is A or this is B. Okay, so our annual cash flow saving A minus B, and the figure comes 3,49,600. Okay, now we compute final answer. That is our NPV. Present value of annual cash flow saving for 25 years. Okay, so our present cash value saving is this much. Into present value equity, present value equivalent annuity factor at the rate of 8% for the 25 year, that is equal to rupees 349,600 into 10.675. Okay, so the value comes 31 lakh 31,980. 37 lakh, sorry, 1 second. 980. Okay, so this is our value. Now initial outlay by referring working note number 1, amount comes this. If we go by okay, so recommendation like this. Since NPV of bond refunding decision is should be refunded. Okay. So student, with this, we have come to the end of our chapter number 1 of our AFM chapter subject, paper number 2. So I hope we have covered all the types of a question here, what are the possible. But please always remember that you should have a develop conceptual understanding so that any type of a question can come. There is no guarantee that what type of question come. But once you have gone through with the conceptual concept is clear to you, then you will not face any problem. So student, before we end our class, I hope it will be better if we start our chapter number 2. I will give you some introduction for the same. Okay, students. So let us start with the next topic. Is our name is risk management. As I told you in the previous class, nowadays CFOs are expected to also handle the risk management profile as well. So basically, in this topic of the risk management, we have started with the what are the various kinds of risk are there. Okay, of course, the list is illustrative only. It is not an exhaustive one. And then we have move our concentration to the financial risk, then how we can have the financial risk. And of course, our I think we are around 4 chapters are dedicated towards this topic as well. That is derivatives, portfolio management, derivatives, foreign exchange exposure risk management, and interest rate risk management. All these 4 topics are related to our risk management in detail. But however, before that, we start with the same. Okay. Now, when we talk about this risk topic, so basically there are some categories of the risk are there. I missed out a slide. Basically, if we see that first, there are different categories of the risk. The first and foremost category of the risk is the strategic risk. Of course, strategic risk is very important. Why? Because unless we take a strategic risk, the business cannot grow. But what happens? We have to see according to the, or we have to mold ourselves according to the changes taking place in the world. Very good examples of the strategic risk are Kodak and Nokia. While Kodak initially have developed the digital pictures, but could not keep the pace with the time, he has ultimately it led to filing of the bankruptcy by the Kodak because they have not forevisioned that what will be the future. Earlier there was a time when there was used to be Kodak reel. I remember that when we were an earlier time before this digital camera has come into the existence, there was used to be Kodak roll. Okay, then we used to develop the take click the picture. Then we used to give this Kodak roll to our roll to the or any other company. Generally, Kodak was dominating. So to the film developer studio, they used to develop the negatives as well as give the card photos printed on the piece of a paper. So this was also a time. Okay, the process was, but nowadays with the invention of the digital printout, digital photography, even nowadays our mobiles are carrying a good quality of camera. Okay, pictures can be moved from one place to another. I think hardly any person except only marriage or any special occasion, there may be some paper photographs are there. All things are digital now. So, but this forevision has not been taken by this product. They could not foresee that, although they have started this digital picture camera, but they could not foresee it. Ultimately, what happens? Other companies have come out, and Kodak has fallen down. Similarly, Nokia. In a one time, the Nokia was leading, we can say leading mobile manufacturer of mobile handset. Okay, no, everywhere there was a Nokia, but their technology was based on the push button. Okay, so they were not, they could not foresee that a time will come that touch screen phone will be smartphone, touch screen and smartphone will come. Initially, the touch screen phone has come, but similar case in with the BlackBerry. BlackBerry has also not foreseen this same. So both of these companies have not foreseen that other companies will come out and they will start. Ultimately, their business will flourish. So all these we can say that they lost their market leadership. So we have to see, it is very important that whenever we strategic risk, to foresee the strategic risk and take the action accordingly. So this is the first risk that any organization face, because ultimately the existence of any organization to a great extent depends on this risk. Okay, now next risk is coming. Another example of strategic risk. What they have foreseen the risk, like Xerox have forevisioned the data forthcoming. We can say they have printing technology. Okay, they have laser technology, and ultimately they have survived the same. So on the one hand, Xerox have survived themselves by looking for another alternative technology that is coming new, because earlier there was used to be dot matrix printer. There used to be noise key like this, and it used to take a long time. But after the coming out this in a laserjet printer, these printers are no more in existence, or even they may be there but very less. Now next comes the organizational risk, is the operational risk. Now this operational risk is very important. Generally, this operational risk is relating to people and the process. Okay, people and process means, this process means any error, any mistake, or any due to some process of the organization, if the organization suffers any loss, that is called process loss. And if due to any people's mistake, we call it as a operational risk. So these are all categories of the operational risk. Now next is the financial risk. That is the main part of our market dynamics, and normally we have the market, and generally we come across, and it is a part of our, we can say it is a core part of our study. So generally what happens in a these risks can be in the form of stock market risk, okay, capital market risk, and even currency market risk. So all these risk categories are there. Okay, so this is one of the operational I have shown here. Sometime what happened, these are very common mistakes, so process and people. Like here, very good example is fat finger case. Instead of 10,000 is 1 lakh is typed. Okay, say if you are making a payment, and even very day-to-day common life, operational risk also you can say, nowadays there are time of UPI is there. Okay, say you go to any market or supermarket, whatever it is, and see what happens. You want to make some payment. Okay, you want to make some payment. You scan the voucher. Suppose you have to make the payment of 100, and mistakenly you make the payment of 1000. So it is kind of a operational risk, because due to this your own error, process error, or process, not process error, it is your human error. You have made a this. Now suppose if you are making the payment, okay, so suppose you have make the payment 100 rupee, right, but the your system fails, or network is slow, or the other amount person has not received the amount. Generally what happens, it is a common dispute in today's time, where we are making the UPI payment. The seller says ki, sir, I have not received the notification of the payment received. You say ki, I have received the payment made notification. So now this what is the reason of this conflict? This is the reason of the conflict, or the we can say this is a kind of a operational risk. Okay, student. So this is one of the kind of a operational risk. Now, when we talk about another examples of the operational risk, these are some leading example. Okay. Now, barring bank's case is a case, very famous case. In this case, what happened? In this case, what happened? The one we can say rock trader. Okay, rock trader, that is Nick Leeson. Okay, what he has done? He has basically you can say taken the unhedged position in the derivative market to make a speculative gains. But what happens? It gone wrong, and ultimately it resulted into the failure of a two. I think it is a 230-year-old bank, Barings Bank. It used to be called Queen's Bank, London. It was a bank of London. So the bank failed because of mistake, or we can say the excessive hedge speculation by one trader, and his name is Nick Leeson. It is also called rogue trading, because see, in this case what happens? Earlier the problem was that on his trading, because see, when in the treasury part there are three portions. One is front desk, middle desk, and back office, or we can say back office, mid office, or front office. Front office is generally treasury desk, and they carry out the trading. Generally, the middle office and the back office purpose is to control, or we can say monitor, the trading carried out by this or front desk. But what happened in case of Baring Bank? All these three offices are under the control of this Nick Leeson, who is handling the front desk. So ultimately, what is going on? That is, nobody can control it. Ultimately, what happens? Excessive, or the over, we can say very huge position taken by him in the derivative market, and ultimately gone wrong. So they have to give the margin call, and for this the bank has been sold at the pound one to the ING bank. Okay, this is one of the famous. Now, recent there is a one very famous case of a cyber attack. Okay, operation nowadays this risk has become very common. IT security, IT risk or cyber attack. It is one of the very leading example of operational risk. In a recent, I think that this AIMS case has happened 2 or 3 years ago, when the all the data has been hacked. Okay, so this is one of the example. Bhopal gas tragedy. This is one of the very leading example of operational risk. And in this, if you have seen, there was a movie on the Netflix, Station Master, maybe the name of this movie. I remember that I've seen this series long, I think 1 or 2 years back. So here it has been shown. I have specially shown watched this movie, this series, because I think it was on a Netflix or somewhere other OTT platform. In this series, I have seen that we can say lack of proper care by the company on the part of management of the company led resulted in the tragedy of this. Their plant were warning plants were not working at all. Okay, so they were not getting repaired the this coolant, etc., and ultimately it resulted such a huge tragedy that led to loss of many lives, and in today's still this is affecting that area. The still affect their affected children are still there, and there many problems are there. Then next is fat finger in capital market. It is a very common error. Okay, in a what happened sometime in a it is generally happens that even when fat finger means a heavy loss in a market. Generally nowadays the punching trading is there. Okay, instead of that, what happens? Instead of typing 10 a share price at it, I'm selling some shares. Okay, they say I want to sell share at a 10,000 rupee per share, but mistakenly, and what I did, I punched the finger at 100 rupee per share. The immediately the moment I will punch this at 100 rupee, from the other side, the buyer who are waiting, and even nowadays these trading are robo advisory based. Okay, so what they will do? They will immediately execute the order at 100 rupee per or share, and say if the volume is large, my company will be in the loss. Okay, so this is kind of a problem, that is or we can say it is kind of a risk, fat finger risk. Now, last is I'm discussing. There are many cases, but I think around 1 year or 1.5 years ago, our Microsoft skin has gone blue everywhere, and even this impact was so huge in the Europe. There many flights have been cancelled out. Okay, so because there was some system updation process failure by this Microsoft, due to which this error has taken place. So all these are example of operational risk. So student, I think before we continue the session, I hope it will be better if we take your queries. Okay, for your queries, we invite you to log in through the Zoom. Okay, for when you will enter into the Zoom, they will ask for a key. So what I am doing, I am writing the key number. There will be a Zoom link. Once you will click at the Zoom link, Zoom meeting ID. There is a Zoom meeting ID. Once you will enter the same, then you will put this number 8270 862 5767. Okay, so I am waiting your questions. Please, student, ask any question. Don't hesitate. Number is correct. 8270. Yes, one student has entered, I think. Yes, Shalendra. Shalendra, please ask your query.
Hello.
Hello.
Yes, sir. I can
Okay,
unmute
Kanaya.
myself.
Okay, Shalendra, just to ask first. I think.
Please ask your query.
Sir, basically, na, I think it was in discussion. So, if when Zoom will start, na, like we can interact real time because after waiting for a closer, na, like during the
Yeah.
class.
No, see,
Hmm.
Shalendra, we are in the process. Actually, earlier if you see the previous batch, na, there was used to be on real time basis. Okay, but due to this time, that there is a portal maintenance work is going on. So that's why it is taking a time, and only this window we have given for a time being only. I think short, maybe in the next class, by Monday, I think it will be clear. Okay, then we will do the discussion real time basis.
Thank you, sir. Thank you.
Okay, okay, Kanhaiya, now ask your query, beta.
Good morning, sir.
Good morning, beta.
Sir, sir, I was checking the BOS portal, sir,
Hmm.
where I did not find the previous material, like the working question papers and all that. So, if you can share the questions that you have done today
Yeah.
and for the upcoming questions in the risk management, so that
Yeah.
we will download in advance and we will.
No problem. You do one thing, better. Although generally what happens, I am again saying that it is due to the portal problem. You do one thing. I am just writing down my email ID. You send a request. Only just say at this email ID. You send the request. I will share the question paper. Yeah, this is assignment at immediately.
Okay, sir.
This is sfm dot dash final. Okay, at the rate ICAI.in. Okay, you just send me request. Okay,
Okay,
I
sir.
will share the question on through email.
Okay, sir, and the second question is like you just discuss about the risk management.
Hmm.
So, sir, can you please briefly summarize the thing so that we will start reading the.
Okay, see, beta, what happens? Of course, risk management. I have to start with the just only since just a beginning. Otherwise, from the next class, we will discuss in detail risk. If I say always we consider as a risk as a only one side, that is always a loss. But whenever we consider the term risk, it is, please remember that it is a deviation. Okay, deviation from the expectation. It can be it can be a loss or it can be gain as well. So risk always does not mean that it is always a loss. Generally, what happens? It is our perception that risk is always a loss. Say, uh, but sometimes what happens whenever we get a gain, so we are happy. We never say it is a risk. I just give a very small example on lighter side or not. You were expecting in a one question paper, you were expecting 60% marks, say out of 100, 60 marks. But suppose you got a 65. Okay, so it was also a risk. So because you have taken some attempt the question at your own, we are not sure ki whether this question will go right or wrong. So you will say, oh yeah, this question is good, and you will feel confident, and you will say, but risk was also there. But suppose unfortunately you lost the marks on this question, and ultimately you got 50 marks. So both way the risk is there. Where there is a deviation from the expectation, risk is there. But now when we talk about the risk management from the CFO perspective, of course, risk is a very wide term. But generally what we expect from the CFO, of course, other risks are to be taken care. And generally there are separate department and there are separate framework. Enterprise risk management is there. And if our paper of this is a SPOM paper that is said, see, there is a risk management. So that paper is mainly oriented towards that risk risk portion, that is enterprise risk management framework. From the CFO perspective, generally the financial risks are more important and generally they are expected to taken care of it. So before we have discussed the financial risk, it is very important that other risk we have to taken care of it ultimately. And why this is important? Because all risk ultimately will result into financial loss. Yes, I have shared with you the categories of the operational risk like Baring Bank's case, AIMS cyber attack, Bhopal gas tragedy. So Bhopal gas tragedy also led to loss of life as well as payment of compensation, etc. Fat finger trade is a directly financial risk. Okay, Microsoft ultimately resulted into loss to the companies. Okay, so this is the background of the risk. Otherwise, in the next class, I will start properly with the introduction.
Thanks, sir. And sir, one more question.
Yeah.
Like sir, you have discussed four to five questions, right?
Hmm.
So, sir, which shows I need to follow for further questions
Hmm.
because AFM is very dynamic. So,
Hmm.
for practice purpose, if you can suggest something for practical questions, so that we will refer those books
Okay.
or.
So you can do one thing better. Refer our RTPs, old RTPs, mock test paper, whatever available on the website. See what our effort is like that. Generally, in addition to study material, most of the questions, additional question we discuss in our class. Okay. And my request to you, please, whenever you do any question, don't cram the question. You see the now this May 26 examination was an example. No,
Hmm,
none of the question was repeated. All questions were fresh. So
right.
be concept develop. My request to you, please develop your conceptual clarity. Okay,
Hmm,
and don't lose the confidence. We are here to help you. Please, you start developing the conceptual clarity. We will help you. Okay, because
okay.
we can ask the question other way as well because it is a paper setters freedom.
Right, sir. Thanks,
Hmm.
sir.
Okay, okay. So, Swarna, please ask your query, beta.
Sir, good morning, sir.
Good morning, beta.
Sir, I've sent the request yesterday also, sir, for the assignment to your
Sorry,
Gmail.
sorry, beta. I have not seen it here because today I will send you to
Sir,
assignment.
one more request from my
Yeah,
side, sir.
yeah.
Actually, you're explaining in a very good manner,
Hmm.
but the thing is that I'm unable to fare the problem while you're solving. Why? Because I was very keen in listening to your explanation.
Hmm.
So, if you can give us a little 2 minutes time to fare the answer.
Okay. Next
Uh,
time I will take care. Next
क्योंकि
time I will take a care.
the important points you are telling, we were writing simultaneously. I was
Okay,
writing
okay.
the क्योंकि
नेक्स्ट टाइम
बाद में रिवाइज करने के लिए काम आएंगे ना, तो
नहीं नहीं बेटा, मैं नेक्स्ट टाइम केयर करूंगा। बिकॉज एक्चुअली मैं बताऊं आपको क्या है, मैं आई जस्ट शो यू, आई डिस्कस विद यू व्हेन वी आर डूइंग द रियल टाइम प्रॉब्लम ना, तो
हाँ
मैं
हाँ,
बच्चों से कहता हूँ जरा बताओ क्या आंसर आया है। आर
यस
यू गेटिंग माय पॉइंट? तो
यस
वो अभी वो थोड़ा कम्युनिकेशन मिसिंग है, एक बार वो शुरू हो जाएगा ना तो
यस
बहुत इंटरेस्टिंग हो जाएगा। आपको कहूंगा आप बताइए आंसर क्या है, इवन स्टूडेंट मेरी मिस्टेक्स को करेक्ट करते हैं। ओके,
यस
तो आप वो जस्ट थोड़ा पेशेंस रखिए, उसमें करेंगे। और मैं नेक्स्ट टाइम अगर नहीं होगा ये, अगर रियल टाइम का, तो आई विल गो अप स्लोली, डोंट वरी अबाउट इट।
यस सर, थैंक यू सर।
Thank you, beta. Have a nice day. Okay. And now I am sharing my phone number as well. Still, you have any query, you are free to discuss me over the telephone with me.
Hi, sir. Good morning.
Good morning, beta. Good morning.
This is Manoj.
Okay.
Sir, for regarding this external fund, this thing,
Mm-hmm.
does the examiner expect us to write the both, or it's like any of the one is fine, sir, like manual calculation or the formula-based thing?
Anyone I have discussed. See, whenever, please, it is a very good point, Manoj, you have asked. Sometimes it is in the mind of the student that in the suggested answer of alternative answer have been given. So we have to give in both answer. No, never. Only one answer you have to give. The purpose
Because
of giving, yes.
because sometimes the question will be asked like shortly, sometimes it will be long answer. So
No,
how
it
does the
hardly matters.
examiner expect us to
No, no,
answer?
no, no, no. Never. See, but I tell you one thing. Alternative presentation means that other possible presentation. Okay, both presentation are correct. So even short answer is correct. Even it will be have a same marks. It will never have a different mark allocation.
Okay, so as long as the explanation and the formulas are correct, it is the weight of the marks will get whether it is long or short one.
Short, it
Correct,
hardly
sir?
matters. Even this is a, see what I tell you. Sometime I just give you a very good example. Sometimes you write something in tables, or sometimes you write in a form of now when we proceed further, you will see that sometime we will write in a form of equation. So answer is the same. Examiner will give the answer to marks to the equal marks to the both answers.
Okay, okay, sir.
So you
And
don't worry about the same.
sir, and one more query.
Yeah.
I just want to know the length of the schedule like FM is going on so that I can plan accordingly for the exams, sir. Like it will
But
be
see,
4 months or
yeah.
5 months.
Yeah, and see, somewhat it is finish off. I think it will be finish off, right? Uh, see, there are 2 classes in a week. Okay,
Sir.
and it will around 40 classes will be there.
Okay.
So somewhere around, I think it will be finished off before the 1st December. First
Okay,
week of
okay.
December, it will be over.
Okay, okay, sir. Because I'm a working professional, that's why I just want to plan accordingly between my work and the class.
Yeah, no problem. We have given enough time because that's why we have earlier there was used to be 3 classes in a week.
Sir.
Okay, so due to this, some students have started the problem. So now I have considered there are 2 classes in a week so that they get enough time for their own preparation.
Thank you, sir.
Thank you. Okay, madam. Okay, Lakshmi, please ask your query, beta. Lakshmi, beta, ask your query. Yes. Lakshmi, we can listen to you, beta. Please speak. No doubt. Okay, beta. No doubt. Thank you. Okay, student, thank you very much for your patient listening. Now, in the next class, we shall continue our discussion on the risk management and we will try to finish off this topic. And it is one of the very interesting topics. So, meanwhile, you revise the same and please send me the request as this email ID so that I can share the assignment with you. Okay, student, thank you very much once again and have a nice day. Thank you. Yeah, can be. Okay, thank you.